Aditya Birla Group presents Budget 2015, the Make in India Budget, co-presented by SBI. The CNBC TV18 and BMR Budget Big Picture.
Well, the budget session is kicked off and it promises to be a stormy one. Changes to the Land Acquisition Act threatens to become a major flashpoint between the government and the opposition. But corporate India and many others believe that Arun Jaitley could come out with an India third dream budget after Manmohan Singh in 1991 and Chidambaram in 1997. With expectations running so high, will the finance minister deliver? How will he balance the fiscal deficit with calls for higher public spending? And will reviving manufacturing get top billing? To discuss all of that and more, we're joined by Mukesh, Butani, Chairman of BMR Advisors, Krishna, Kumar, Vice Chairman and Managing Director at Philips India. We'll shortly be joined by Ravi, Uppal, Managing Director and CEO of Jindal Steel and Power. Also with us, Arun, Duggal, Chairman of Shriram Capital. Gentlemen, appreciate you joining us this evening on CNBC TV18. Mukesh, let me start by asking you about the context. The need for a big, bold, reformist budget in the context of where we are as far as the macroeconomy is concerned. You don't have the twin deficits that we were faced with both on the current account as well as the fiscal deficit. Fiscal deficit also much more manageable in comparison to the situation we were facing under Mr. Chidambaram and the UPA. Oil prices have come down substantially and the biggest beneficiary, or one of the biggest beneficiaries, is India. In that context, the hope is that he gets a little bit of fiscal space and a little bit of fiscal room to actually deliver a bold, pragmatic, reform-oriented budget. Do you think that we're setting ourselves up for disappointment yet again?
Well, I'm optimistic about the budget on an overall basis, but to your point on what room does he have, given all the positives that you talked about in the context of crude oil prices, and also they did not press the button on the food securities bill last year, so there's a lot of savings that is accruing. The simple mathematical calculation suggests that it will all depend on what kind of fiscal deficit target he's targeting for 15, 16 and 16, 17.
So 3.6, which he's pretty much said
and
that he will maintain. If he wants to spend a little more on infrastructure, maybe 3.8, and I don't think anybody will quibble with that.
So let's assume it's 3.6. He wants to stick to that. Also bear in mind the other context is that your corporate tax collections are not going to look very rosy, and this new government is going to be very realistic about projecting tax collections, in which case he's just left around with anywhere between 30,000 to 50,000 crores
to play around with. Yeah.
Which, if you consider in the context of need for infrastructure funding and other social programs that they may come out with, it's not a great deal of money. So I think if he follows the larger advice that's coming from the wise men, he may want to expand the fiscal deficit, make more money available, channelize those into building capital assets, into public infrastructure. I think that will give the kicker that the new government is really looking out for. So which camp do you belong to? Do you believe that he will say 3.8 as opposed to 3.6, that he will try and stimulate the economy by way of spending on infrastructure, for instance? Shereen, I'm not a subject matter expert. I'm not an economist. But based on what's coming from, Bimal Jalan and what's coming from Mr. Reddy, it suggests that he may want to relax and not strictly become obsessed by that figure of 3.6 and 3.1 and rather channel the money in the right direction. I think that I go by that.
It's a balancing act that he has to do. But Krishna Kumar, let me ask you this, because we'll talk about revenue mobilization and expenditure management in just a bit. But the theme, and that's what we're positioning it on CNBC TV18, it's the Make in India budget, and this has been the big dream and the big aspiration as far as this government is concerned. Corporate leaders that I've been speaking to are now saying that Mangne ka zamana gaya. So, forget about asking for exemptions and so on and so forth, but to really make in India a reality, specifically as far as manufacturing is concerned, beyond exemptions or relief on MAT, what is it that you're looking for?
Yeah, quite honestly, I don't think it is exemptions or reliefs that industry or corporate India is actually looking for. I think critical would be three critical points of action. One would be to improve the investment climate and investment approvals in India. The second critical would be for us to improve the cost of resources in India, particularly land, land reforms as well as access to capital. And the third key piece would be really defining a tax policy for the next 3 years, that we have a visibility to a clear roadmap, and we have an end to tax terrorism. And I think if we are able to accomplish all of these three elements, I think Make in India would be a reality.
But does it worry you now? Because, you know, at the start of the budget session today itself, on the very first day, both houses of parliament have been adjourned. The land ordinance, we've got a dharna on at Jantar Mantar, and it seems very clear that the land ordinance is not going to pass through parliament, at least not without a fight being put up by the opposition. Does it worry you then that the Make in India dream is going to be put on the back burner, at least until you sort out this very significant piece?
Well, honestly, I mean, we are a democracy, right? And I think everybody understands that. That's why I think it's critical that we look at it not just at the budget, but also the budget session, because the government's ability to be able to implement a lot of the reforms that we've been talking about would really be visible through the budget session, given the challenges with the upper house. So while land is a controversial topic by its inherent nature, there is a lot that the government can actually do in terms of enabling better access to capital and cost of capital. There, I think, to Mukesh's point, meeting the fiscal deficit will actually come in handy.
Exactly. Because that's what the Reserve Bank is looking at.
Exactly.
And the cost of capital is incumbent on what the government does with fiscal consolidation, because then it gives the Reserve Bank the confidence to be able to move as far as interest rates are concerned. But Mr. Duggal, you know, beyond manufacturing, as far as the financial services sector is concerned, the capital markets are concerned, channeling investments or savings is concerned, what do you really expect from this budget and from the finance minister? What would you like to see him do?
I think this budget, as you said in your opening comments, is a very, very important budget. And it's not only in terms of technically meeting the certain targets, deficit numbers or other targets. It is to give the country and the investors, both domestic and international, a renewed sense of optimism and a direction that this is the path we're going to follow. And that I'm reminded of two things which have not been talked about much since the last election campaign. One was that minimum government, maximum governance. And government has no business to be in business. Now, those are the two things which does not cost any revenue. Those are the policy things that we are going to go ahead with privatization or reduction of government control over a very large segment of the industry and the
But do you believe that this has become slogans or these have been relegated to slogans? I mean, even if you heard the President speak today in his joint address to both sessions of Parliament, he talked about minimum government, maximum governance. He talked about some of the other issues that you've just raised here. Do you believe that this has now been relegated to the realm of sloganing?
Not at all. I think this is a leading policy direction which now needs to get translated into action. These are the steps we're going to do to reduce the size of government. These are the steps we're going to do to simplify the procedures for approvals and so on, ease of doing business and all that. And now two specific things. We have been waiting for privatization or reduction of government ownership. Let me talk about banking sector. A very large percent, 70+% is in public sector. And we know something needs to be done there to get those banks be managed by the boards rather than by the ministry.
But don't you get a sense of confidence, because they have started to talk about that. They're yet to translate that into action, even as far as bringing down government stakeholding in public sector banks is concerned. They've said it will be capped at 51%, but you can go down to 51%. When they start to offload is a different matter altogether. But does it give you confidence? At least they're talking about that. They've articulated a vision in that direction.
They have, but a lot more needs to get done.
Do you expect a specific number being provided by the finance minister saying that we will offload so much and accrue this much on account of divesting in public sector banks, for instance?
I'm hoping that they will say that they will set up a bank holding company and put the ownership of all these banks in the bank holding company.
Didn't we have the exact same conversation last year,
We did. We were almost close to that. And I think progress has been made in that area, at least at the ministerial level. And there are a lot of challenges to that. But unless the public sector banking issue is resolved, the financial sector will continue to be, suppressed by that.
Okay, Mukesh, let's talk about revenue mobilization, because as you pointed out, corporate tax collections will continue to fall short of what the government is projecting, even if they're a lot more conservative than the previous regime. What could be the revenue mobilization ideas? We've talked about bringing down, for instance, your holding in public sector banks, a higher, more aggressive disinvestment target. Whether or not they finally meet this year's target is still a question mark. But what else are we likely to see, or what else can he do in terms of revenue mobilization?
I think raising tax rates is clearly not a solution. So part of revenue mobilization will happen when the economy picks up, growth levels are higher. But I think there's a lot that can be done to increase the level of compliance. The compliance level in our countries is still abysmally low. There is an element of fear in the minds of people to go and approach the taxman. We've saw a steady increase in the number of taxpayers in the last 8 years, but if you see the trend in the last 3 years, it's remained pretty much constant. I personally feel that we should have at least 2 to 3 times more citizens paying taxes than what we are currently paying. So if you ease the compliance for a taxpayer, you'll automatically see the taxpayer base going up.
But any specific measures that you expect in this budget?
I don't anticipate anything in this year's budget. I think there has to be a sense of undertaking deeper administrative reforms to be able to address this problem.
Let me also welcome Ravi Uppal. The coal auctions have clearly got your attention, which is probably why you're walking in late into our studio, Mr. Uppal. But beyond the auctions, and that is a process that is underway at this point in time, what are your key expectations as far as the finance minister is concerned?
Well, the key expectation is that he has to act a lot more sensitive towards the core sector industries, because they are the ones who have suffered the worst in the recent years, which by that I mean mines and minerals, steel industry, the power, all these industries suffer a lot.
Specifics, give me specifics. He has to be sensitive to every sector. Every sector on this table has a wish list that they want the finance minister to be sensitive to. What would you like him specifically to address? Let
me take steel industry. Steel industry contributes nearly 3% to the national GDP. This industry is going through one of the worst phases at this point of time. That's partly because the domestic demand hasn't looked up, and whatever demand came is being taken by the foreign supply like Chinese and the Russians. So we basically feel that the finance minister must provide the necessary protection to domestic industry, because there's no level playing field out there.
Okay.
And the industry representatives, including the Ministry of Steel, has made a strong recommendation to Minister of Finance that the domestic industry must be protected. Also for the reason that the government is pitching in very strongly for this industry to hike up their capacity to become world's second largest supplier.
So protection by way of higher duties on imports for the steel sector, that's what you're hoping for at this point in time. Beyond that, what else?
The second thing is the auction process, for the iron ore and the other metals must also go on soon after the coal. Because we have been very badly affected due to closure of many mines, and consequently the price in domestic market really shot up, which was not in line with what the global trends were. Therefore, we want to have abundant, sort of supply of iron ore and the other coal. I think one of the things that we really have to migrate, in this country is from a regime of shortages to a regime of surpluses. Because these basic input materials should not become an issue of concern, because they are not so internationally. Why should they be allowed to continue that way in this country?
Okay, that's a good point to take a break on. We should move from being a regime of shortages to a regime of surpluses. The finance minister would hope that he doesn't have to deal with the fiscal deficit as well. But we'll have to talk about all of that after we return from this short break. Stay on with us. You're watching the CNBC TV 18 BMR Budget Big Picture. We'll be right back in a minute.
The CNBC TV 18 and BMR Budget Big Picture.